I'll take this opportunity to highlight the milestones and achievements made during the last financial year and to discuss some of the challenges we faced. I'll also talk through both the mobile and energy businesses in more detail and the execution of our strategy. Turning to slide 6. The 2019 financial year was a reset year for the business. There is no doubt it was challenging. But as I reflect on the year, I can comfortably say that we're in a great position to focus on our core businesses and we have the necessary resources to execute on our strategy. In August 2018, we made the tough but necessary decision to close the mobile device store. A few months later, we were able to sell the broadband business for a good price in a really tough market. This was not an easy task, especially given the uncertain operating environment and the need to migrate customers to the new owner, and I'm pleased with the team's achievement. Exiting these businesses has enabled us to allocate capital into our two core business units, mobile and energy, both of which are expected to deliver better returns compared to broadband and devices. The mobile market continued to be highly competitive. The network operators' growth at any cost mentality had a negative impact on ARPU across the entire market. However, the three network operators are now turning their attention to the investment required to roll out 5G while maintaining their 3G and their 4G networks. We anticipate this change will slow the decline in ARPU, and it will lead a return to sustainable pricing in 4G services. The early signs are positive. Financial year 19 was an intensely competitive year in mobile, and during this time our mobile plans were less competitive than we would have liked. So we made the rational decision to materially reduce our marketing spend. We did this throughout the financial year, and we focused our efforts on improving our wholesale terms to unlock needed agility and competitiveness. This resulted, not unexpectedly, in a 4.8% decline in our recurring subscriber base for the year. Approximately 18 months ago, it became clear that significant regulatory change would be introduced into the energy market. This came to fruition on 1 July 2019, with the government threatening to wield its big stick of regulation, which created a regulatory cloud over the energy industry and, as a result, our business. Unfortunately, most regulatory attention is focused on the retail margin. This represents only 6% of the retail energy cost stack, rather than focus on the huge costs of wholesale generation and distribution. Despite the challenges we have faced, we have achieved several important milestones that I'd like to take the opportunity to reflect on, as it is these achievements that have put us in great shape for financial year 20 and beyond. As a prelude to those achievements, we bolstered the board and made key changes to the management team. 2 new non-executive directors joined our board and they're here with us today. I'll talk about them in the next slide. I rejoined the business in the role of CEO, and we welcome Gareth Turner as our CFO. In March, we completed a $50.6 million capital raise, providing the capital required to restructure our debt, freeing up our balance sheet and enabling growth-friendly covenants. We ramped up our marketing initiatives, and it will help us ramp up our marketing initiatives in mobile and help us build and launch our disruptive subscription energy plans and invest in our technology stack. The further integration of the Click Energy business into the amaysim group enabled us to realise operational efficiencies and some cost benefits. We also activated, but have not launched, our subscription energy services across Victoria, New South Wales and Queensland, and I'll discuss these in more detail later in the presentation. To support the subscription energy product launch next year, we engaged a new specialised subscription billing platform, Zura, that will eventually support all our subscription services and our revamped software stack. Perhaps most importantly for the mobile business, we signed a revitalised network supply agreement with Optus in May. This agreement has changed the way we acquire data, and it underpins the growth of the mobile business going forward. The new arrangement enabled us to quickly launch more competitive plans to market, and just days after signing, we launched new $20, $30, $40 and $50 mobile plans. With good quality and good value plans in market, we ramped up our marketing spend, and these new plans are already performing far beyond our expectations. Turning to slide 7. I would like to take a moment to welcome our 2 new non-executive directors who joined the business earlier in the year, Gertz and Craig Jackson. Both Gertz and Craig join me here today. They're 2 the ruggedly good-looking chaps at the end of the table up there. These directors both bring extensive international expertise and deep experience in their field. Gertz brings a strong technology and media background through his roles as an advisor and director of numerous public and private companies in those fields. He also brings significant capital market expertise with his roles in investment and private equity firms. Craig also brings extensive experience in capital market expertise through his 40+ years of professional accounting. He also has an extensive directorship expertise, having held numerous director roles during his distinguished career. Once again, a very warm welcome to both Gertz and Craig. I'll now move on to talk about the mobile business and how we are performing, having launched new mobile plans in June. Slide 9. The mobile market continues to evolve, and the trend is with us. As mobile devices become more expensive and their longevity improves, the bring your own device category is set to continue to grow, as does the propensity for non-contract plans. Market research shows that more than 70% of mobile handsets are now BYO, and the MVNO market is forecast to grow by 44% over the 5-year period to June 2022. There are currently a substantial 35.4 million services in operation, SIO, in Australia, of which the MVNO market accounts for 10%. Recent competition in the mobile market has put some of the smaller MVNOs under pressure. However, we maintain our dominant market position with 34% of the total MVNO market, and we are well positioned to take advantage of potential growth opportunities that emerge in the sector. Moving to slide 10. As I mentioned previously, the new network supply agreement with Optus enabled us to launch a suite of highly competitive plans to market in June, and this slide calls out some of the successes we have had to date with these plans. Since the FY19 year, we have grown the mobile subscriber base substantially to 648,000 at 18th of October 2019. This is an additional 24,000 net recurring subscribers since 1 July. We've continued to receive excellent customer feedback, and the latest NPS survey conducted showed that our Net Promoter Score was the highest it has been since May 2017 at +44. To reward the loyalty of our subscriber base, we have moved existing customers on the $20, $30, $40 and $50 plans over to the new and improved plans without charge. This has had a significant impact in reducing churn and increasing renewal rates. We also beat the big name telcos to be awarded Canstar Blue's Customer Satisfaction Award for prepaid mobile providers, and Finder awarded us the best postpaid month-to-month SIM under $40. The plans that we have in market are highly competitive, and we've positioned the plans to target all segments of the market, and this strategy is proving highly successful. However, to continue to grow, we not only need to have great plans, we need to have continuous marketing to support them. The launch of these new plans meant that we were able to ramp up our marketing activity and kick off several initiatives to drive mobile subscriber growth. We are running a multi-channel marketing strategy that's focused on customer acquisition through digital channels, television, radio, out-of-home marketing and retail promotions. Such marketing will be sustained throughout this financial year. We have historically been very successful at digital marketing, and it continues to form a key component of our customer acquisition strategy. Our online digital marketing activities across various platforms continue to drive traffic to the website and sales conversions. We trialled out-of-home advertising that commenced with adverts across billboards, buses, outdoor furniture and radio. These adverts were in all major Australian cities and on national radio, including Nova, Today and Triple M. I'm excited to announce we've hired a new Chief Marketing Officer, Renee Garner. She joined the business on the 14th of October 2019 and due to a prior commitment can't be here today. Renee brings extensive marketing experience, particularly in the energy sector, having previously been Head of Marketing, Planning and Segments at Energy Australia and a Director of the Energy Retailers Association of Australia. If you'd now turn to slide 11. This slide highlights how our marketing activities have driven subscriber growth, and it demonstrates the success of ongoing marketing activity. Given the positive results over the last couple of months since ramping up our marketing activity, we will sustain a higher level of marketing activity in order to maintain this momentum. The capital raise completed in March provided us with additional capital to increase marketing activity. As mentioned in our FY19 results announcement, we plan on increasing our marketing spend by up to 15 million in mobile and will continue to invest for as long as we see quality growth, which delivers a healthy return and which drives long-term strategic value. Looking now at slide 12. This graph depicts the mobile base growth on a month-to-month basis, split between the recurring and the as-you-go customer base. Recurring mobile subscribers now total 648,000 as at 18 October 2019. This represented growth of 19,000 in the first quarter of financial year 20 and a further 5,000 net subscribers in the first 3 weeks of October. The new plans are also having a positive impact on churn. We listened to our shareholders who asked for us to reintroduce reporting on mobile churn and are pleased to report that average churn rate across the total combined base for the first quarter of financial year 20 was 2.4%. The composition of our subscribers continues to skew towards the recurring subscriber base, which now accounts for 65% of the total base as at June 2019, up from 55% at December 2018. We are also beginning to see signs that ARPU decline is slowing, and the market is showing signs of returning to sustainable pricing as the large network operators begin to vacate lower price points. We remain cautiously optimistic on ARPU over the medium term as MNOs focus on funding investment in their networks. I'll now move on to the energy business, slide 14. The full impact of the significant regulatory change that the market has undergone is still yet to be seen. The market is in a state of flux, and it is for this reason that we made the prudent decision to reduce our investment in marketing our traditional energy plans until there is more clarity around margins. As a result of this, we've seen our energy subscriber base decrease to 203,000 in the first quarter of the financial year, as against 207,000 at the end of financial year 19. This is not unexpected, and we are keeping a close eye on how the energy market develops and how consumers respond to the default market pricing. Put simply, we see no benefit in growth for growth's sake. Amid the regulatory overhaul and customer disenchantment with the energy sector, we see an opportunity to remove complexity from the market and improve the customer experience. In short, a need to disrupt the retail market with a subscription service built for the energy customers' express needs. It is the regulator's desire to make energy pricing more competitive, fairer, simpler, and more transparent for consumers. We saw this change coming, and as a result, we began to make several changes to our energy business some time ago. We've done away with pay-on-time discounting and repositioned our energy plans to have more margin from day one, to the detriment of competitiveness. Furthermore, and perhaps more excitingly, we've developed entirely new energy plans. Subscription energy services were soft launched in Victoria in April, and we have since switched on the service in New South Wales and Queensland. Before I talk you through the benefits of these, I would like to set the scene of the energy market. If you turn to slide 15. This is a market that looks like the mobile market a decade ago. The pricing constructs are confusing. In mobile, you used to pay for calls, texts and data on an as-you-go basis, yet it was never clear how much each activity would use and how this would impact your bill. This is the same in energy today. There is a lack of transparency. You had no way of knowing how much your bill would be for your mobile before compulsory usage notifications were introduced. Smartphone apps which showed usage information and set monthly prices with fare included value. While you may have a rough idea how much your energy bill will be, most Australians have no way of seeing the cause and effect between usage and price. We think that this is unfair, bad for the environment, makes it impossible to take control of this important part of our cost of living. There is limited access to your energy usage data, and it isn't simple to understand. The mobile industry developed the platforms to allow users to easily track usage. However, in energy, most people don't have smart meters, and even those who do are not empowered or may be encouraged to take control through this valuable data. This issue shouldn't come as a surprise, given that the major energy retailers are also generators and make the most of their money from generating energy, and that means that they're heavily incentivized for usage to grow. In mobile, it used to take weeks, sometimes months, to switch provider. It still takes weeks or months to switch energy provider. However, most mobile ports happen within minutes. The mobile market had poor customer satisfaction. This is the same in energy today. Energy companies have some of the worst ratings for customer satisfaction, whereas now mobile have some of the best. There is no doubt that this is due to the issues I just mentioned. And finally, bill shock among energy customers is high. Our research shows that over half of consumers experienced bill shock in the past year. On month-to-month mobile plans, this rarely happens as customers pay a set monthly price for their plan. All of this creates a market that is ripe for disruption and in dire need of change for the benefit of the consumer. We are perfectly placed to drive this change. We have the desire, the experience and the capital. We have built and deployed such a subscription energy product ready for a full launch early in 2020. The subscription energy plans are energy plans that look and act like a mobile plan. If you now turn to slide 16, I'll discuss these in more detail. The subscription energy plans come with a no lock-in contract, and they're charged monthly. Importantly for customers, there shouldn't be any bill shock, as the price is the same each month, and any need for top-ups is known well in advance. Also, top-ups are charged at the same price as the underlying plan. Customers can monitor how they are tracking throughout the month and top up if they go over their allowance for the month. The mobile app allows customers to track their energy usage. This provides transparency so users can monitor energy usage and clearly understand how different activities drive usage. For example, does being vigilant and turning off the lights over a few days materially change usage, or are usage spikes really caused by too many hot baths? Furthermore, customers can roll over unused energy for up to 3 years, meaning excess energy can be stored in a virtual battery for a cold winter day or steamy summer one. This subscription method puts predictability and control in the hands of the consumer. Furthermore, all plans also come with a smart meter, no extra cost. We are incredibly proud of these plans and are confident that in time, they will disrupt the market. These plans, despite all their benefits, will not be an overnight success. Consumers need to become accustomed to purchasing energy in this way, and the focus for us now is to educate the market on the benefits of subscription energy plans. We are in for a major battle because the incumbents are incentivized to maintain the status quo. Slide 18. I'd like to wrap up this presentation by reiterating our strategic priorities and our outlook for financial year 2020. There is a significant strategic value in our mobile subscriber base, and this year is all about growth of that base. We have already achieved a number of milestones towards this goal, including signing the revitalised NSA with Optus, and the new plans and marketing initiatives are making excellent progress in growing the subscriber market, the subscriber base. This year, we developed and made available our first subscription energy services across the three most populated and contestable Australian states. We have already seen some organic growth of the subscriber base, and this continues to grow steadily as we are still testing and optimising some of the functionality of the plans. The capital raise completed in March has provided the additional capital to invest in our marketing activities. As announced at the FY19 results, we will spend up to an additional $15 million in FY20 on marketing mobile. Already our efforts are paying off, and our latest customer satisfaction survey results are a testament to those efforts. We are also investing the capital raised in March in the tech stack, with a planned $5 to $7 million over the next 2 years. Our technology underpins our business and enables us to deliver superior service and plans to our customers, and it is one of our most important assets. Moving to slide 19 and looking ahead. To grow mobile, we will continue to deliver excellent customer service to drive retention and lower churn. Our competitive plans and commitment to providing new and existing customers with the best available plan in the market is key to ensuring our customers stay with us longer. Furthermore, we have begun new upsell initiatives which reward our existing customers for their loyalty through plans which are not available to new customers. The MVNO market is likely to experience a period of consolidation following the intense competition, and we will consider complementary bolt-on acquisitions to further grow our market share. We are now working towards several new features to the subscription energy plans that will widen the potential market. We recently completed the addition of solar and will soon roll out concession schemes across Victoria, New South Wales and Queensland. We've been continuously testing and optimising the user experience in the plans and the functionality. In the second half of financial year 20, we expect to launch a substantial marketing campaign to support customer acquisition. Through this marketing plan, we also want to drive awareness and educate consumers on the benefits of our subscription energy services and highlight the downfalls of traditional energy pricing. Our increased marketing activity not only focuses on customer acquisition, but is targeting and driving brand awareness. We've established a brand that is synonymous with simplicity and customer service. However, we now need to amplify this to a wider audience. Our excellent customer service that not only rewards customers for joining amaysim, but rewards them for staying with amaysim. This will play a key role in ensuring we maintain our position as a consumer champion. The energy market remains under a regulatory cloud, and the mobile market is not yet out of the woods, but is showing early signs of moving towards sustainable pricing. Notwithstanding, we reaffirm our financial year 20 underlying EBITDA guidance of 33 to 39 million and are on track to achieve this. Slide 20. Before I hand over to Andrew for the formal items of business, I would like to remind shareholders what sets amaysim apart from its peers. Our lean and scalable operating model, made possible as we do not have infrastructure or networks to invest in, and the strength of our technology and our wholesale partnerships means that we are able to acquire and service customers at a lower rate and a faster pace. We have an engaged and satisfied customer base. We are obsessed with our customers and with providing them great value and excellent service. Our values of agility, simplicity, reliability and empathy underpin everything that we do and how we behave. It is also these values and behaviours that have created a vibrant culture of people in amaysim who care. We also have a strategy that is squarely focused on growth and supported by a strong balance sheet that enables us to take advantage of the growth opportunities in front of us. I'll take this opportunity to thank our team for their commitment and the hard work over the past year to get the business into the shape it is today. I'm incredibly proud of what we've achieved. There are silent heroes in our organisation, some of whom are here today, and they work every day to provide our subscribers with the best possible service, and I thank them. I also thank the board and the management team for their dedication, valuable insights and support throughout what has been a challenging year for the business. I am confident that following this reset year, we are in a position to support growth as we move through FY20, and I am pleased with the progress of the business so far. Finally, I extend our appreciation and thanks to all shareholders for their ongoing support. Thank you.